Welcome back for all those in the metals markets, gold traders, and investors. Welcome to Lupo Markets, where we're taking a look at the structure of the gold market on this Friday. It's June 19th, 2026. It's about 3:03 in the afternoon, New York time. And as we left it last week, the market is still in a bear market trend. You can see that based on just the price from left to right, prices are going down. That's not too hard to figure out. You can look at it from this angle. And also what you see is we're still trading well under the 40, 50-day, 50 period moving average. Here, this is a 40-day, 50-day average we've been using. And what's interesting this week, as you notice, the counter rally was really rejected at around 4,400. That's what we were looking at. And we had mentioned there's some structures there above 4,400 and some really serious supply lines. And that's exactly what the market met. It met up there at a real severe rejection. And we did indeed deploy the models. We'll update with the performance on the website here at lupomarkets.com. It was a good week. This is really unusual that you have, so much order, if you will, in the marketplace. And I know there'll be those that say, well, we had a big 2.5–3% move. But as you know, the geopolitical headlines were volatile, and it was to be expected. And also, when you come into a key structure point, which is where we were right here at the L2, that's usually where you will see a very significant, a very dramatic, sometimes market reaction. And that's what we saw also as we went into the teeth of the supply line. So the models are still bearish. The structures have been deployed. We took them off towards the close of this week. This is Juneteenth celebration in the United States. It's a federal holiday, so that kind of cuts down on the liquidity. And the market was oversold after the hawkish response from the Federal Reserve. We'll get a chance again to deploy next week some more of the bear models into the structure, into the gold market. Again, being that it's a holiday, we don't have the commitment of traders report. It has nothing to do with quant trading. I always enjoy those sharing that as a sentiment indicator and also a perspective on how the markets, both the big traders and the small traders, are positioning themselves based on the price action. We don't really have a model. It doesn't really feed into the model. It just helps with the overall picture. So we'll leave it at there for this week. As you can see, we'll do an update early next week. Again, everything is still bearish. The models have been deployed. The volatility and the spreads are within reason in the futures and in the cash market. So it's a good stable market, and it looks like the trend will just continue downwards until we see some sort of resolution under the lower level structures. It's hard to see that, and to see any further until we get down there and see what the market is made of. I know there's been a lot of talk of the central bankers buying. That doesn't necessarily inspire a lot of confidence if you know the history of the central bankers selling gold at 240 and 220 in London back in 1999 and 2000. We might be dating ourselves a little bit there. But nevertheless, let's let the trend be our friend, and everyone have a really good weekend. Thank you all so very much. We'll tune back in for market structures early next week, the week of the 21st, 22nd onwards in June, the year 2026. Thank you all so very much.